Okay, so once you have forecasted income statement, then next step is that you forecast balance sheet. Again, before you forecast balance sheet, you would need to have past data of balance sheet. So again, you will need a sheet for balance sheet past data, which is the balance sheet worksheet. So as you look into it, I have just replicated whole balance sheet of the company from its annual report to this sheet. So it starts with assets, current assets, then fixed assets, then current liability, total assets, then current liabilities, then long-term liabilities, total liabilities, then shareholders equity, and so on. Total liability and shareholders equity. So this has just been taken from annual reports. Any problem so far? So you can just take this data for 2 years from annual report, 2 years, 3 years, whatever you want to. Now you have to make forecast, and we are forecasting for next 5 years because 5 years is a good time period to make your forecast. Otherwise, you can also forecast for 10 years, 15 years, whatever you want to. But time value of money becomes so small after 5 years, or everything becomes pretty much stable after 5 years. That's why general rule is, or general practice is to forecast for 5 years. Okay, so for balance sheet, a key point to remember is that once check if your totals are matching with the annual report. So maybe there is a typo in putting something or something. So make sure that you put in formulas at least in totals so that you know everything is going fine. And at the end, add a row for checking the balance. So balance sheet should balance. So if there is any what you can say difference herein, then you need to check balance sheet for your for errors or for whatever. So put a row at the bottom with the name of balance just to check the balance, which is total asset minus total liability and shareholder equity. These two should be zero. And obviously, whenever you just open the balance sheet, just on top of it, you cannot find out whether is it balanced or not, and you will have to always go and check for it. So instead of going and checking for it, put a check here. So put a check that if absolute sum of all these values is greater than zero, that means it is not balanced. So if I take all these values as positive numbers, if I take their sum and if I take it as absolute positive number, and if it is greater than zero, that means it is not balanced. So if absolute value of this sum being greater than zero happens, then it is not balanced. And then I am asking Excel to show me this text check in the cell. So it will write here check if it is not zero, if sum is not zero, if there is any balances out. Otherwise, it will mention zero. Okay. So this will tell me if the balance sheet is balanced or not. So if it is okay, that means it is balanced. If anything goes out, if I put 5 here, it will convert to check. Any problem so far? Second is that how does it change color? So we have put in a conditional formatting here. So you go to conditional formatting, highlight cells rules, tax that contains. So I will write tax that contains okay should be marked green with dark green text. And similarly, I can say and press OK. And then I can again open conditional formatting and say that tags that have check in it should be marked light red or should be marked green, light red filled with red text. So this is how you can apply conditional formatting. So far currently it is okay. So it is good to have such checks in your model. This check is very important because as you go ahead, you will have to make your balance sheet balanced, and for that purpose, you will need to keep checking it. Any problem so far? Okay, so this is just the structure of balance sheet or putting a check up there. Now next step is that you start forecasting the balance sheet. Which means you need to make balance sheet notes sheet in order to forecast it. Cash is not forecasted through balance sheet because when you make cash flow statement, then cash should come in here from cash flow statement. So there would be some people or some analysts who would just forecast cash and just make or fudge the numbers or put in. But then again, that wouldn't be accurate forecast. So it should come in from cash flow statement because only cash flow statement will tell you how much cash do you actually have. So, and that is also again a check if your P&L, balance sheet and cash flow are accurate. If there is any problem in any of those statements, then balance sheet will not balance. So cash and equivalents available for sale investment securities. This is simply your investment. So if we are making any changes to this investment, investing more, investing less, then it would impact cash as well. So once I have made the cash flow statement, then I can take its assumption, or for now I can assume safely that it will remain be constant or same because this is an investment which I have already made. So until and unless I plan that I will be making an additional investment herein, I can assume safely it to be constant.